What's up, everyone? It's Scotty with MoneyVest. So we've got a big inflation report coming out next week on September 13th. That's going to be a Wednesday, and that is going to be for the month of August. So I'm going to break down everything you need to know about the upcoming August CPI, and that is going to, once again, be very, very decisive for the market in terms of interest rate expectations and, of course, market direction as well. So hope you guys enjoyed this video. Find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below if you're interested in joining, and of course getting access to all the buy and sell alerts, options alerts, trade ideas, members only private videos. I posted a private video for members only today going over 20 stocks that are on my shopping list, as I like to call them, and with my fair values as well. So these are all companies that I believe to be the strongest, fastest, most high quality businesses, stocks that I'm planning to buy if and when they drop down to my intrinsic value. So yes, my buy targets and my no-brainer buy targets, at which point the prices, stocks would be just insane values, would also be included in that video. So that's going to be with the link down below. I did open up a few more spots if you're interested in joining and getting access to members only private videos. Link's going to be down below. So the August CPI report, here it goes, and very, very important catalyst for the market without a doubt, because CPI is what drives interest rates, is what drives the market. So it's all a chronological process. And for investors, the August CPI that's set for release next Wednesday is a crucial and important indicator and the last major inflation report the Fed will get before the September meeting as well. So we do have an FOMC meeting later this month, and we've also got the Summary of Economic Projections, the SEP, coming out later this month as well. So the consensus right now, according to economists polled by FactSet, is 3.2% on a year-over-year basis, and for core to be expected to have climbed to 4.3% on a year-over-year basis, and that's going to be up from 4.2%. Now, this right here is going to be Bank of Cleveland nowcast, inflation nowcast, and they are expecting the September print, or so in other words, the September 2023 numbers on a year-over-year basis to be sitting at around 3.8% for headline, and then 4.29, so just under 4.3% for core, which is going to be a dramatic increase from 3.2% headline to 3.8%, and for core to be sitting at just about 4.2, 4.3%, and they're expecting about 39 to 40 basis point increase on a month-over-month basis. So again, inflation nowcast from Bank of Cleveland. It's not always accurate. In fact, very rarely is it actually accurate. So I would take that with a grain of salt because, again, they honestly, in my opinion, they don't know what they're estimating most of the times. This right here is going to be the month-over-month change. So again, in July, we did see a 0.2% increase. August, we're going to be comping over 0.2% from last year. And September, October is when I do actually believe that there is possibility for us to see some significant disinflation because we would be comping over some very, very high numbers, and that's going to be around 0.4 to as much as 0.5%, right? So those are going to be pretty significant month-over-month increases for inflation. And when we're comping over those numbers, I do believe that it's possibility that we are going to see a bit of a decline. So now going over to the actual inflation print, the main reason as to why inflation overall has been dropping pretty aggressively is on the back of energy prices, right? So we've already seen June 9.1%. It's now sitting at just over 3%. So the majority of that decline has come from energy prices. Now remember, inflation has two different ways of coming down. There's disinflation and there's deflation. Those are two very different things, right? Disinflation is basically the rate at which inflation is going up, it's coming down, right? So that disinflation is the rate of increase is slowing down, and deflation is straight up prices going down on a year-over-year basis. So right now where we sit, energy is in deflation, because if you'll notice that these negative numbers, that means energy prices are lower from same time last year, right? So they have seen a significant decline in energy prices. So energy, for example, down over 12.5% on a year-over-year basis. So it is indeed in deflation. But other parts of the market and other parts of the economy, such as shelter, still increasing 7.7%, albeit at a slower rate. So it is still in disinflation right now. And food prices are also still up 4.9%. So yes, it's still higher than same time last year, but at a much slower pace. So once again, it's in disinflation, something I mentioned in our Discord as well. So you can see that overall inflation has come down, but energy went from a significant amount of inflation to deflation, and now it's starting to tick back higher, which is also what my concern is for future inflation prints, that if energy prices, if oil prices, crude oil, and natural gas, if they keep pushing higher, well, then guess what? Inflation, once again, is going to have that upward pressure for it to move higher as well. Services, less energy services, they have, once again, been coming down. 6.1% is where we're at. So it's in disinflation right now. It's not quite in deflation at the moment. And this is what Tom Lee also tweeted just a few hours ago, talking about the Manheim Used Vehicle Index. In August, final released this AM, index was down 20 points or down 18% from December 2021 peak. And they are expecting a significant, they're expecting more declines of about 29% in order for it to come down to its long-term trend and long-term averages, right? So, and they expect vehicles and services is 15% of core CPI. So this decline is going to result in core CPI also coming down. As we already know, Tom Lee is, of course, almost always bullish. So take that with a grain of salt as well, right? Because used car prices, yes, they've been coming down. You can see that over here, that used car and trucks, they are also down in deflation, down 5.6%. So yes, that could accelerate further. Well, but then shelter prices, they're not coming down. And of course, energy prices are starting to move back higher. Not that it's included in the core CPI, but of course, it's going to affect headline CPI and then other services as well, indirectly, right? Now, speaking of shelter, there was another tweet from Steven that basically mentioned that if you take a look at the spot rents, right, CPI's lagging measurement of rents is currently causing a drastic overstatement on inflation, he says. If you take a look at the spot rents right now, then the actual headline and core is under 1% on a year-over-year basis. So we are in significant deflation already, because if you take a look at spot market rent adjusted and spot market rent adjusted for core, we are at very, very low prints compared to the actual inflation being reported, taking into account the lagging effects of the overall CPI. So he goes on by saying that failing to adjust for spot market rents during times of an enormous divergence to the CPI's lagging rent-based measures increase the odds of exacerbating economic extremes, while the Fed focuses on lagging indicators of inflation with both headline and core CPI inflation expected to be below 1% year-over-year on spot market rent adjusted basis in August. These underlying measures of inflation are strongly suggesting the Fed's policy is far too tight. Now, I don't know about you, but I don't really feel that rents are coming down. And I'm not sure where these spot rents are coming from, where they're suggesting that rents are already in deflation, because on a year-over-year basis, there's no way rents are down. In fact, this was reported just a few weeks ago. Rents are falling in America for the first time in years. So in May, the national median asking rent was $17.39, which was up $3 from April, but down 0.5% from May 2022. So, okay, so on a year-over-year basis, we are now finally starting to see rents come down, but it's not to a point where headline and core is going to be sitting under 1%, at least not in my opinion, because most of the times we've seen rents keep going higher, right? If you come back over to shelter prices, I don't think I have shelter prices here. Maybe I do in the future. There we go. So year-over-year, 7.7%, which again, on a year is still an increase. Yes, it's starting to moderate. Yes, it is starting to slow down. So we're seeing some disinflation, meaning the rate of that increase is not positive anymore. If anything, we're starting to see rents go down on a year-over-year basis. So we're starting to moderate a little bit. But overall, I mean, it's still pretty strongly up compared to what energy, and of course, some of the other sectors that we've seen. Which says that apartment rents are on the verge of declining due to massive new supply. So rents in August were just 0.28% higher than August 2022. So once again, on a year-over-year basis, we're starting to see a little bit of an increase in rents in August as well. And compare that to a year ago when rents were posting an 11% growth. So again, it's in disinflation, but it's in no means deflation at the moment, because that rate of increase is obviously going down. This right here is going to be interest rates. So we are seeing, of course, the market's expectation is that we're going to stay here for longer, so higher for longer in terms of interest rates at 5.25 to 5.5%, and of course, cuts that are priced in all the way through 2024. And then finally, this is my expectation from the upcoming inflation print on Wednesday, where CPI year-over-year, 3.2%, core CPI year-over-year 4.3%. That's what the market's expectation is. But of course, a hotter print is going to be bearish. A softer print is going to be bullish. That's how simple it is, because if you do see inflation come in hotter than what the expectations are, that's going to reignite the potential fears around interest rates. And the market's going to start to sort of assume that interest rates are going to be increased by the 25 basis points. But of course, if you get a softer print, that is going to be very bullish for the market, in my opinion, because once again, we're going to reaffirm, or basically the expectations for rate cuts are going to continue, as we have already seen. So that's where we are with the overall inflation picture. In my personal opinion, I think inflation is going to come in line with expectations, if not somewhat better. But energy prices are on the way back up, and we're not going to see the effects of those energy price increases until the next few quarters, until the next few months, actually, in the few quarters, because the energy price increases in the month of September is not going to be reported until October and the following months. And then, of course, shelter prices are the big wild card, which I don't believe right now we're seeing a significant decrease in rents as of yet. So let me know in the comment section below. I'm going to be ready for the print. Of course, we'll be live streaming it on our channel. So make sure that you drop a like, subscribe to the channel. As always, happy investing, and I'll see you all in the next video.